Real estate versus stock market, where should you invest? Most Americans face this exact dilemma at some point in their financial journey. You have some money saved up, maybe $50,000, and you are wondering whether to put it into real estate or the stock market. Both can build serious wealth over time, but they work in very different ways. So today, we are going to break down everything you need to know so you can make the smartest decision for your situation. Let's start with real estate. When you invest in real estate, there are several ways you make money. First, you earn rental income, that is the monthly cash flow that comes in from your tenants. Second, your property appreciates over time, meaning it grows in value. Third, your tenants are essentially paying down your mortgage for you, which builds your equity every single month. And fourth, real estate comes with some of the strongest tax advantages available to any investor, including depreciation deductions and the powerful 1031 exchange. Here is a simple example to make this real. Let's say you buy a home for $300,000. You put down 20%, which is $60,000. You collect $2,200 in rent every month. After your mortgage payment and expenses, you are left with $500 in profit every single month. And after 30 years, that property could be worth $600,000 to $900,000, and you collected rental income the entire time. That is wealth building on multiple levels at once. Now let's talk about the stock market. When you invest in stocks, you make money through capital gains, which means you buy a stock, it goes up in value, and you sell it for a profit. You can also earn dividends, which are quarterly payments that certain companies send directly to investors. But the real magic of the stock market is compound growth. When you reinvest your returns, your money starts growing on top of itself, and over time, that becomes incredibly powerful. Here is the same $60,000 example applied to stocks. If you invest $60,000 into an S&P 500 index fund, which has historically averaged around 10% per year, after 30 years you would have over $1 million. And the best part, no tenants, no repairs, no midnight phone calls about a broken water heater. Just completely passive growth. So how do these two investments compare side by side? Real estate requires a lot more money to get started, usually $20,000 to $60,000 or more just for a down payment. Stocks, on the other hand, let you start with as little as $1. When it comes to liquidity, stocks win easily. You can sell a stock in seconds. Selling a property can take months. Both can generate passive income: real estate through rent and stocks through dividends. Real estate gives you the power of leverage, meaning you can borrow money to control a much larger asset. Stocks do not offer that same advantage without taking on serious risk. Real estate also gives you more control and stronger tax benefits, while the stock market gives you easier diversification and far less management headache. Real estate has some major advantages. The biggest one is leverage. When you put down $60,000 and take out a mortgage for the rest, you are controlling a $300,000 asset. That multiplies your returns significantly. Real estate is also a tangible asset. You can see it, touch it, and improve it. It generates steady monthly income, provides powerful tax shields through depreciation, and acts as a strong hedge against inflation because rents and property values tend to rise over time. But real estate also has serious downsides. It requires a large amount of money upfront. It is very illiquid, meaning you cannot quickly turn it into cash if you need it. Tenants can create stress and unexpected costs. Maintenance, vacancies, property taxes, and insurance all eat into your profits. And because you are putting a large amount of money into one single property, your risk is concentrated in one place. The stock market has its own set of advantages. You can start with almost nothing. It is completely liquid, you can access your money anytime. Index funds make it essentially effortless to invest. You can spread your money across hundreds of companies with a single purchase, which reduces your risk dramatically. And there is zero management involved. But the stock market has its own challenges too. It is emotionally difficult. The market can drop 30 or 40% in a downturn, and most people panic and sell at exactly the wrong time. You have no control over the companies you invest in. Dividends are taxed as income. And the ease of buying and selling can actually work against you if you are not disciplined. So who should choose real estate and who should choose stocks? You should lean toward real estate if you have at least $40,000 to $60,000 saved up, you want monthly cash flow, you are willing to put in some time managing a property, and you want strong tax deductions. Real estate also makes more sense if you live in or near a market with strong rental demand. You should lean toward stocks if you are just getting started and do not have a lot of capital yet, you want a completely hands-off investment, you might need access to your money in the near future, or you simply do not want the responsibility of managing a property. But here is the smartest answer of all: do both. Most wealthy Americans do not choose one over the other. They use both strategically. They use stocks for long-term growth and liquidity, and they use real estate for cash flow and tax benefits. A simple allocation could look like this: 60% in index funds like the S&P 500, 30% in rental property or real estate investment trusts, and 10% kept in cash as an emergency fund. So here is the final takeaway. If your goal is building long-term wealth, both options are surprisingly equal over time. If you want monthly passive income, real estate wins. If you are starting with little money, stocks win. If you want the best tax savings, real estate wins. If you want the easiest and most passive experience, stocks win. And if you want the best protection against inflation, real estate wins. The truth is, you do not have to pick just one. The wealthiest people in America use both, and now you know exactly how to do the same thing. Credit counselor or consult with a bankruptcy attorney. Many offer completely free consultations. And remember, this video is for educational purposes only and is not legal or financial advice. If this video helped you understand what's at stake, share it with someone who needs to hear it and subscribe for more financial information that actually matters. Thanks for watching video and do not forget to subscribe to my channel.